you can rent your apartment or your condo or your house to your business. And the rent that your business pays you is not taxable up to a certain number of days per year. So interesting enough, if you want to have a board of director meeting or some type of fiscal responsibility meeting or marketing meeting over lunch in your home, rent your home to your business. And we actually, there's rules around it. But, a lot of our clients take their first $20,000 to $50,000 a year of income tax-free. Why? Because it's a deduction to their business, right? The business is renting a third-party space, and it's not taxable to you, and you happen to own the house, and your business chose to use your house because it has the right to do that for the meeting.
Entrepreneurs, we're going back to the finance sector. We are bringing on the tax dork, as he says, and I love that because he is so dedicated to his craft. I'm excited too because we just made the joke of not the name you may see in Hollywood. This is Mark Myers, but needless to say, he has a lot to offer. Mark, thank you so much for joining That Entrepreneur Show.
Hey, thanks for having me, Vincent. I'm excited about being a tax dork today with you.
Well, I appreciate you taking some time. And he is streaming in from here in Florida, which is cool, a few hours away because Florida being such a big state. But I'm excited to shed some light on another Florida entrepreneur. Let me give him a little preview before we get this show on the road. He's the founder and CEO of a 15-year-old company. So congratulations on sustaining that. Taxwise Partners, where he's helped thousands of business owners permanently reduce their tax bill on average by at least half without replacing their CPAs or investment advisors. Over 90% of America's small business and medium-sized businesses significantly overpay in tax. I certainly believe that, and I'm looking forward to diving into that more. I want to start somewhere that caught my eye on the sheet you sent in. How to get the IRS to fund a portion of your retirement 100% tax-free. We've got to talk about that.
Yes, that's well, there's a number of ways to do it, Vincent. It's actually interesting. It's not just one way, but essentially what we're doing is looking at the code. And just note, my work is exploratory. For the last 15 years, but particularly the last 10 years, all I've done was seek out the coupons. When I say a coupon, I'm talking about a tax code that you can effectively apply or correctly apply, and it results in reduced taxes. But so when I'm talking about coupons, I'm just talking about codes. There's 75,000 pages of tax code. There's lots of coupons in there. Unfortunately, the IRS doesn't send out a flyer every week like Publix does and says, hey, here's your weekly discounts, here's your coupons. So you have to find a dork like me that knows where they are and knows how to apply them for you. But to your question, whenever we can apply one of these coupons and reduce the taxes and have a net gain that essentially you would have never had if you didn't apply that tax, well, that's free money, right? Because it would have been a tax bye-bye to the tax authorities. Now you have free money. And now if you never pay the taxes again on it, well, now you get into the uniqueness of cash value life insurance. I'm not marketing cash value life insurance. That's not my thing. That's most of the people that I work with are financial advisors, and maybe they say take a portion of your tax savings and put it there. But whenever I talk about that, Vincent, I'm just talking about, well, if you didn't have to pay the tax this year and you kept a lot more money in your pocket and you never want to pay the tax again, put it into a cash value life insurance policy or a Roth if you're, but obviously you're not going to be eligible for a Roth if I'm working with you because you make too much money to put into a Roth. And then you never pay the taxes again, right? Because CV cash value life insurance is just going to grow and deferred, and you can take loans against it. So that's kind of the shtick on saving taxes now and never paying taxes again. And who basically gave you that incentive? Well, the government did because it's in their tax code. So they're the ones that are funding your essentially cash value life insurance policy if you want to go that route. But again, I don't manage money. Yes, I have an insurance license, but I rarely use it. And I don't step on my referral partners' toes. Most of the people, all of my business comes from our business, Taxwise Partners, comes from CPAs, enrolled agents, registered investment advisors. They bring us in and introduce us to their clients to reduce their tax burdens.
Well, I love the expertise you're bringing to the show. That's one of my goals, many goals I have with guests, of course, to add value. But this is something that is not a regular guest. Everyone, be sure to stick around to the end to find out exactly where to find this gentleman online. He already offered one golden nugget. He's about to offer another. Eliminating long-term capital gains on the sale of appreciated assets. I don't mean to sound wordy for everyone listening on, but there's value in that. Let's dive in.
Sure. I'll be quick with this one. So Vincent, as you know, just going through life, there's times that you're looking to sell something. And it just so happens that you bought it for a lot less than you're going to sell it for, right? Which is a good thing, right? When you can have that profit. But the problem is, as you know, the federal government and the state, if you live in somewhere other than Florida, right? We chose the really good state, good sunshine, no state income tax.
No state
But
income
the
tax.
government, the IRS, the feds or the state are going to say, Vincent, good job for selling that real estate or that private equity or those stocks, whatever you have that has appreciated in value. Give us 20%, 23.8%, possibly up to 37% of your gain in tax. That would be a California client. And that hurts, right? You're like, wow, I just lost like a quarter to maybe up to 37% of my gain that, so what we do is we say, hey, there's a better way. Depending on the type of asset, and of course, a couple of other scenarios, we can take the asset prior to it being sold, right? This is don't call me or reach out and say, hey, I actually sold my property and I made $500,000 on it or 5 million or whatever the number is. And I'm like, I heard you can reduce the tax. And I'm like, when are you going to sell it? Like, I already sold it. I'm like, wait a minute, it's too late. I'm really too late to the party. So prior to the sale, we reallocate the equity, whether it's 100% of the equity in the asset. It can be cryptocurrency, it can be private equity, it can be stocks, it can be real estate, whatever it is. We need to reallocate either all of the ownership or a portion of the ownership into another entity. And now when the sale happens, you didn't take constructive receipt of the income because the other entity is the one that sold it, and the other entity has a different way to handle the taxes. So now the interesting thing with that is we're either going to be able to defer the tax, potentially multi-generational, or we can possibly eliminate the tax depending on the entity and the situation. So the question I always ask is, if you're going to send 20 to 37% off to the IRS when you sell that asset, why don't we redirect the equity into another entity and not sending off? Whether or not you just defer the tax, which is better than paying it all at once, because now you can grow the money that you would have paid taxes on, or you eliminate the tax, even better. That's a better strategy, but I just need about a 60 to 120 day runway, right? Prior to the asset being sold, and no purchase agreements being signed for the most part. Because once you sign a purchase agreement, you've constructively taken receipt of the income, even though you haven't received it yet. The IRS says, no, Vincent, you signed the purchase agreement, even though you haven't received the money yet. If nothing changes in that agreement, you've already taken the money. So you're too late to move the money outside of, so there's a little rules here though. So call me in advance. Let's put it that way.
Well, I'm smiling extra big because I happen to be in Florida, so I know I'm in his jurisdiction, where his wheelhouse. That's great. But everyone, especially if you're viewing on, you see the passion this guy's bringing to the show. Brings me back to usually the first question of the show, but the natural conversation did not allow. Did you always want to become an entrepreneur? Did you always want to own your own tax service? Let's walk our audience through this.
Great question. And the answer is yes, I've always wanted to own a business and do well, right? I've even though I work well in teams and for others, I'm always the kind of guy that wants to do it myself, right? Yeah. I think I can do this efficiently. So I've always wanted to own a business. Now, have I always wanted to be a tax dork? Absolutely not. I never would have. In a million years, I would have never thought that I was helping people save taxes. I went to the University of Florida. I got my exercise physiology degree.
Right.
And I got my master's degree in sports management. So people are asking, how in the world are you now a tax savings architect or tax dork, whatever you call yourself. Well, I ended up running high-end health clubs in New York and Los Angeles for a number of years for a company you're probably pretty familiar with, a really high-end brand in New York City, right? Equinox, you probably heard of them. And I just was really efficient in running their stores, and I really learned how to run another company's businesses.
Right.
So understanding P&L and driving profits and loss, I actually left that business because I wanted to own my own business and I didn't want to own a fitness club, but I knew that I could run a business. So now what business am I looking to run? So I went into financial services and the consulting, which ultimately started in insurance,
Of
but
course. Yeah.
landed me in advanced tax planning because there's not enough people doing what I do. And there's a lot of opportunity there.
Everyone, let's focus on what he just said. There's not a lot of people doing it, and there's an opportunity there. Sometimes it's okay to be another fish in a bigger sea, but in many cases, we're in two different fields, but I'm working on podcast production services coming to clients. There's not a lot of competition for me right now, and I'm going all in. He is in his own niche, his own world right now. I'm hoping the two of those stories combined can inspire you out there to get out there and get creative, make it happen, niche down again. He realized that he didn't want to be in a certain area, and now here he is, about to give us one more golden nugget. How any high income earner can reduce their annual in tax by 30 to 60% without changing their CPA or investment strategy. Now, you gave us some new tips already. Is there anything else you can throw on top for this?
Absolutely. I'd love to. And here's the thing, not everybody sells an asset that has appreciated in value significantly.
Right.
But everybody receives income. Well, hopefully they do because they're working. We want everybody out there being gainfully employed or gainfully working for themselves, obviously as entrepreneurs and maybe employing others. And you got to pay taxes on that income. So what kind of coupons can you use against that ordinary income tax? Well, there's dozens. So that's where I come in. And, I'll give you one little nugget here. If you own your own business and you're an S Corp, or a 1065 partnership, probably not going to be a C Corp if you're a small business. Well, you can rent your apartment or your condo or your house to your business. And the rent that your business pays you is not taxable up to a certain number of days per year. So interesting enough, if you want to have a board of director meeting or some type of fiscal responsibility meeting or marketing meeting over lunch in your home, rent your home to your business. And we actually, there's rules around it. But, a lot of our clients take their first $20,000 to $50,000 a year of income tax free. Why? Because it's a deduction to their business, right? The business is renting a third party space and it's not taxable to you. And you happen to own the house and your business chose to use your house because it has the right to do that for the meeting. So that's just the chip shot. We can take generally anywhere from $20,000 to $50,000 of taxable income off the plate for any business owner. Obviously, W-2 earners, we got to go different routes on those coupons, but we can help them as well.
I love that advice. Thank you. I'm an S Corp owner, so I certainly love the advice. You've given us so much, but I want to circle back to something that I love asking my guests here. Mark, if you could sit down with any entrepreneur that you have not met, dead or alive, who would you choose?
Wow. Henry Ford.
Love going back in the day. Let's hear why.
Well, he was an innovator. I think that his mantra was, he knew that he wasn't the smartest person but he surrounded himself with people that were smarter than him. So he could essentially go to them if he didn't know the answer to the question or needed to solve a problem, he would just go to the people around him that knew the answers to the problem to create the solutions. So I thought that was very good wisdom. And of course, he cranked out those Model Ts and did well for himself.
Oh man, and I love just the pre-Google era, right? We can't just hop on Google, find ways to solve our problem. No, this is no textbooks, even probably nothing. Here we go. Let's delve deeper. Where would this meeting go down if you could pick the location to?
Man, it would have to be, and of course, now we have to think about is he coming to 2024 1904 or am I going to 1905, right? Or 1907? But if
That's
I'm
balls in
going,
your court. Balls in your court.
yeah, all right. So if I'm going to 1907, I want to meet him in the city. I want to meet him in your town, in New York.
That'd be cool. Back in the
Yeah.
day, see the original factories and how things came to life. That would be something. It would certainly be a lot of inspiration. But I want to thank you so much, Mark, for taking the time. Here we are starting we're about lunchtime now, getting ready to get some contact info for you. But I had to thank you so much before I do that. You really added a lot of value to our audience. And again, everyone out there, I'm trying my hardest to get you fields that are not repetitive and get you every entrepreneur in different sectors. So you definitely checked off that box, brought us back to the financial realm. What's the best website for you? Where can we find you online?
Sure. Just go to taxwisepartners.com. And that's just as it's spelled, tax and then wise is WISE, taxwisepartners.com. Finding a lot about us. We also have, complimentary appointments. You want to jump on for a 15-minute chat, no cost. We'll talk about your tax liability, but just, we want to make sure people have a big enough tax liability for us to have the conversation. So usually we want to see people paying at least $30,000 or more in taxes before it makes sense for us to chat with them.
I love that. Well, thank you very much for sharing that. And everyone out there, be sure to go to his website, taxwisepartners.com. Check out all the great stuff they have to offer. With that, the show is at That Entrepreneur Show on all podcast platforms, on all social media platforms. And I am at Vincent A. Lancy on the same. Be sure to subscribe to my YouTube channel to get some video clips from this episode a few weeks after it goes live. With that, we are signing off here, both of us in Florida, which I love. Thank you so much, Mark.
Thank you. Take care.